Continuing with the trend, the tone that we've set since the morning about the journey that India will take as investment professionals and as capital allocators, an important piece in that is the alternative investments piece. And to talk about that, the next session is on private market investing in India. And it is my pleasure to invite Mr. Rajesh Sehgal, the Chairperson of CFA Society India, again on stage today because we can't have enough of him today. So I hope you enjoy this session as well. Rajesh, please again.
Good evening, everybody. You got to see me again, once again. And the last time I promise, I wish I could change my voice or appearance or something. So but this session is like we were discussing, the original session for which I actually signed up. I said, yeah, this one I want to do. It's very close to my heart. It's about alternate assets. And I think we have the privilege and are fortunate to have Srini here. Let me give you a brief introduction that I have made it brief. It's very, very long. I've made it brief because I said, okay, we've all had tea and coffee, but we still don't want to listen to too much about that. But I think Srini, in fact, in the alternate asset market needs no introduction. He's the prime force behind Kotak Asset Managers, Kotak Alternate Asset Managers. He's the one who spearheaded that entire business, which is now $22 billion AUM and AUA all put together. He's played a crucial role in setting this up right from the earlier days, when he became part of the Kotak family or the Kotak business. Once upon a time when they had a JV with Goldman. So I think from those days. He's, we will hear from him about all the things that he knows, which includes real estate, infrastructure, special situations, credit, private equity, and investment advisory. So, okay, I have one more page to read, which I will not read, but Srini, please welcome. Big applause to hear about his views. Please. Yeah. It's called a fireside. There's no fire though.
As long as the markets are on fire, that's good for everybody.
So Srini, thanks for coming here and spending time with us. As you can see, we've all been here since early morning, and the interest level just refuses to die down. I think this is one of the sessions that quite a few people here have been looking forward to, including me. It's very rare to hear about private markets, alternate assets from someone like you who's really seen this whole thing grow. So why don't I allow you to share with all of us your journey, how you started, where it is, your views on markets, business, etc., where India is today in terms of alternate assets, all of that. And I promise we have a lot of questions. We already started getting questions. You all haven't even heard us, but I already have questions.
Well, first of all, good evening, everybody, and thank you for having me here today. I do hope that over the next 30 or 45 minutes, whatever I'm able to share with you, what I've learned is useful to you as professionals. To your question, Rajesh, in terms of how I started this particular journey, I was thrown off the cliff to actually do this. I was in the investment banking business, as you mentioned earlier, which was a joint venture with Goldman, with Kotak. I had done that for about 16 odd years. But I had gotten tired of that by 2004, 2005. So I said, I'm not going to do this anymore, and I'm done with this. So the conversation went like this. They said, what are you going to do now? Yeah. I said, I don't know what I'm going to do, but I'm not doing investment banking anymore. And if any of you are aspiring for a career in investment banking, I can tell you it's a good career, but beyond a point, you need to find something else to do. So around that time, the firm was discussing to set up a private equity fund, and they had hired one of the other private equity fund managers, and the government had opened up real estate investment for foreign investors. And somebody said, why don't we start a real estate fund, and why don't you start the real estate fund? I had no knowledge whatsoever of a real estate fund. The only experience that I had was of buying an apartment in Mumbai, putting all my savings into it, as you know, and I said, well, we'll give it a shot. And that's how it started, actually, with the first real estate fund back in 2004, 2005. it was baptism by fire. There is a lot of learning which I'm happy to share as we go along. But over the last 20 years, we've been a beneficiary of the India growth story. We've also been a beneficiary of being able to seize opportunities as it came by, and I'm very thankful for many of our global institutional limited partners or capital providers to have put the faith in us and given us significant amounts of capital for multiple strategies. And today, the business verticals include, as you mentioned earlier, nearly $4.5 billion of real estate investment, $3.5 billion of special credit investments, private equity is about $1 billion, infrastructure is about $1 billion. And in addition to that, when the regulations in India changed, when private banking was a distribution business, but now they have a category called registered investment advisor, where you don't get compensated by the product manufacturer. It is the investor who actually pays you. And I can tell you, investors are very difficult to get payment out of. That's the other business that we have, and it's a very significant business. That's about close to $9 billion. So long and short of it, we've been able to build this business over the last 20 years, and it was a hard climb in the first few years. Happy to answer more questions as we go along.
So a couple of things, I think this whole learning by being thrown into the water or thrown into the fire, whatever, I think I have a similar story. I got into private equity the same way. I think just before this session, you heard my ex-boss, Dr. Mobius here. And we were in a meeting with an institutional investor in the US. And the conversation was about listed markets. Suddenly this gentleman turns around and says, you know what, this is 1999. This is $100 million. Emerging markets is what you guys do, so invest, but not listed. And we're like, we don't do unlisted. I mean, at Templeton, we never did unlisted. And I was the guy in the meeting with him. I had just joined Templeton at the time, by the way, 98, 99. So Mark looks at me, yeah, of course, he's the guy. So this is how I learned about private markets as well. But I think the big difference here, and I think one of the reasons which I really want to share with all of you, and I want him to bring it out, is that this is the first business in India on the private side that is truly scaled up. We do not have Indian private equity funds which are as large. I mean, now, there are few you can count on your fingers, maybe not even 10. But you were the true pioneer who were, we now understand, thrown into it by accident. But you built up something which is very aspirational. I think everybody here, and I speak on everybody's behalf, who's running a private markets business would aspire to set up such a esteemed, reputed institutional business. So if you could throw some more light and share your story with us as to how this came about to be. It all looks good today, right? $22 billion, 10 here, 12 there, real estate, all of that. It looks very good. But, share with us how you laid those bricks.
Yeah, look, when I started this and I was to raise the first fund, which raised the first fund from the domestic market, about 60% of the money came from family offices, very small family offices in those days, not the size that we had. And we were fortunate to get some capital from some of the institutions like LIC at that time. So the first fund was actually a $100 million fund. And the timing of the fund was right, so the investments did very well in that. And we were obviously ambitious. We wanted to go to the international market to raise money.
Yeah.
And remember, I've been an investment banker for the previous 15 years, and we are used to sort of launch an IPO, get on a plane, go on a roadshow, and boom, you get $1 billion. So I thought raising money should be easy for this too. And I've done this like for donkey's years. And so I got on a plane and went to all those places and thoroughly got slapped in the face and came back. 2 or 3 things I learned in that, which I want to share with all of you here. I think the first big difference between, let's say, a mutual fund raising money versus an alternative or private equity fund raising money is the emphasis on the alignment of interest of the investor's capital or the LP's capital with that of the fund manager. What I mean by that is that in each of the funds that we raise, the team, individual members of the team, it is not about the Kotak brand, it is not about X. Individual members of the team have to put their own money at stake alongside the investor, And that is the first level of comfort that the investor seeks, which is something that I did not know when I went out to raise money, which is not the case in mutual funds, as you know. I think the second aspect of it was that the investors, actually many of the investors, and even today, if you really think about the global institutional pools of capital where the monies are, there are global pension funds, there are sovereign wealth funds, and there are endowments and foundations, and of course family offices. Generally, the endowments and foundations have been ahead of the curve. They were investing in alternative assets much before some of the other pension funds and others did it. But they have a very set formula. None of the endowments and foundations will give money to somebody like me, and they still have not. Yeah. Why? Because I represent the Kotak Mahindra brand, and that's a negative for them. They like individual fund managers who are starting out and who own the asset management business. Yes. The way they think about it is, if you are so good, you should be doing your own business rather than working for somebody else. That's the way they think about it. You can't question them. But I don't have any money from the endowments and foundations. The money that we have is from sovereign wealth funds and pension funds globally. So I think that's a big learning that I had when I was marketing and talking to investors. I think the other thing that I learned was that it requires a very high degree of perseverance to be able to convince and to get the investor comfortable with what you intend to do. Remember in 2004, 2005, India was still not a very discovered place. Yeah. And while many of you may think that Kotak is a big brand, you show up in California in a place like to one of the pension funds called Chairperson and another one called CalSTRS, they don't know Kotak at all. I mean, for them, it's just some guy who's just showed off the boat. So you got to start all over again. You got to start from India. You got to start from who you are. You got to start from what your firm is, and that getting the familiarity going takes time. So the perseverance of going and talking to investors and being consistent about the message that you give to the investors was a big learning, and it required a lot of patience, a lot of miles. Sure. Before you have the first breakthrough. But most importantly, once you do get the first capital, to be very, very responsible about it, to show empathy with what the investor is thinking, and of course transparency and governance. Even if the fund doesn't perform, as long as the investor believes that you did your best and you did what was right on behalf of the investor, that's I would say, the number one thing as a fund manager that you need to follow. So for me, the learning was the perseverance to go after these big investors. We had at that time, and some strategic decisions one had to take at that time. We were approached by many global players, like Templeton, for example, or many others, who were not as familiar with India and who wanted to do a joint venture on the asset management business, joint venture for, let's say, the real estate fund business, etc. And we had a hard choice in front of us. We do know that all joint ventures anywhere in the world also start with a prenup agreement as to what you will do and how you will separate yourself. So the question was, should we go down the hard path of forming a joint venture and just raising money because somebody else has the ability to raise the money versus doing it on our own? And we had a bunch of learnings from our joint ventures with Goldman and Ford in the past, and we decided that we'll go it alone. And the second question that we asked ourselves in those days was, where are these global fund managers, the likes of Blackstone, KKR and others, getting their capital from? And that's when we discovered they get the capital from the pension funds and sovereign wealth funds, which in our own internal language, I call it the Gangotri. That's where everybody gets money. So we said, we should go to the Gangotri, why go to the tributaries? And that's the focus that we had right from 2005, that we will go to the big LPs directly, even if it means it's going to take us a couple of more years to get the first check out. And that, I think, is what you can see today. That perseverance that, you spend a couple of years just making sure, cultivating that relationship, building the relationship.
Great, excellent. I think lots to learn from what he just said. I mean, I'm still digesting some of that. But I think in the meantime, let me just highlight that we have this app, and you guys can all ask even more questions that you want to direct, to Srini. And for you, I think we have that chart on the screen now. If you want to refer to it, you want to talk about it.
Yeah. Look, I talked about perseverance earlier, and I talked about patience. Private equity investing is by nature more riskier investment than public market investing. The first definition being that in public markets, if you see the environment changing, you can press a button and get out of your position. You cannot do that in private market investing. Whether it's private equity, whether it's venture capital, whether it's real estate investment, it's illiquid by nature. Indian market today is not yet pricing in the liquidity premium or illiquidity premium for private market investing. Most HNI investors, family offices, really don't sort of differentiate between the two. You go and talk to some of the large family offices, they'll say, oh, why should I invest in this? My public market investing is giving me 15% return. But private market investing is about reasonable returns, but compounding over long periods of time. And that's very important. You can get a 15% return in the public market for 1 year, maybe 2 years. How do you compound the money? Many gurus in the public markets would have told you that once you own a good stock, you should let it compound for long periods of time. Private market investing is all about getting a multiple on capital and how you can get the money compounded over 5, 7 years, because that's what your money is going to be locked in about. The second aspect that, what I want to sort of depict in this chart, if I may stand up, is that, we've been in this business, as you can see, from 2005, September, until 2022, that we are here today. The country and the businesses have gone through various cycles. And what is important, even if you have very significant amount of capital, is the ability and the art not to invest. The temptation to put capital to work because you have all the capital commitment can be a very great temptation. We, as private equity or alternative fund managers, have the luxury of staying out of the market, unlike a mutual fund manager. A mutual fund manager, you have handed over the money to him, it is sitting in the bank, it is causing him a drag on his portfolio's performance, so he has to put it to work. Unlike a private equity fund or an alternative asset fund, it's just a capital commitment. The money is not lying in my bank, it's lying with the investor. When I find the investment opportunity, I call for that capital. And if I don't think that the market is conducive enough or the market is overvalued, I will not put capital to work. And that's very, very important. And that patience is very important. And I just want to point out to, so we started the business in 2005. We raised the biggest fund in 2007, just before the global financial crisis. 20% of the fund was invested prior to the global financial crisis. And this period, we stayed out of the market. We stayed out of the market from February 2008. September 2008, all of you know what happened. Lehman Brothers collapsed, the market collapsed. This was the period prior to that every global investor, the Goldmans, the Lehmans, the Warburgs, everybody was investing billions of dollars into real estate in India. The legacy of that, if all of you have traveled from, let's say, South Bombay towards this venue, when you go on that flyover in Santa Cruz, on the left-hand side, you see a big slum running into about 7 acres. That is owned by Lehman Brothers for $700 million. 2005, it is still a slum. Now, you can be, so when we looked at all of these things, we said, maybe either the global investors know something that we don't know, and the conviction that, whether we are right versus they are right, it's a very hard call to take at that time. But we took the call that, nope, we don't understand what's going on. We will stay out of the market. And we stayed out of the market until the crisis happened. Everybody vanished, and we were probably the only few players who were sitting here understanding what was going on. And around that time, the government actually changed the regulations with regard to foreign investment into participation in rupee-denominated debt securities. We saw a window of opportunity using that regulation to provide high-yield structured debt capital to real estate guys who were completely starved of capital. There was no global investor anywhere in sight. The banks had been hurt. Nobody was providing capital. But fundamentally, the market was still decent. There was still an underlying demand for residential real estate, for example, and there were many other cases where you could underwrite it on a very conservative basis. And therefore, immediately after the global financial crisis, we were one of the largest investors in the market, and we put out significant amounts of capital at average returns of 19 to 20% IRR. And we had a field day until we came to 2014. So 5 years, 2 funds invested, we were comfortably harvesting 20%. But since we were making a lot of money as high-yield credit strategies, the non-bank finance companies in the country thought that they can do a better job of doing the same thing, start lending to real estate companies. and they had a levered balance sheet. And they were happy to take the kind of risk that we were taking. Ours was an unlevered balance sheet, i.e. I call for capital, I invest it, and I give it back. I don't take any leverage against the investment. But NBFCs decided to do that, and this period, we did not know what the NBFCs were doing and why they were giving the amount of money that they were giving. And we were reasonably sure it's going to come home to roost. So this is the period that we stayed out of the market again. And we were waiting for the NBFC bubble to burst. We were simply harvesting whatever we had invested at that point in time. And sure enough, IL&FS happened in 2014. If you open the Economic Times on that day when the IL&FS scam was reported on page 1, and you go to page 3, there's a headline article of us exiting our last investment from the previous fund. And this time when we had actually got commitment from 2 sovereign wealth funds in 2013 for putting about $250 million to work. We nearly signed the document, but 1 month before signing the document, we went back to the investors and we said, look, we don't think we can start putting capital to work. We don't want your commitment, keep it back. But when the NBFC crisis happens, we will come back to you. So we were able to refuse capital from investors who are giving us. So patience and ability to say no to capital as well is very, very important. Each of those cycles that I talked about earlier, when we were not doing deals, many of our competitors, NBFCs and others were doing deals. 2 things are important, and this is for some of the young professionals here. We had the highest turnover of young professional staff at that time. Why? Because the young professionals felt, oh, they've been sitting here for 12, 15 months. They have not done a single deal. What will they write in their resume? Will their resume be valuable or not? And therefore, and when they were reading in the newspapers that XYZ, ABC is doing a deal, and they were saying, these guys are sitting here in my investment committee rejecting everything that we do. They were worried about their personal professional career. And this is another important lesson I want to share with you. Professional careers run into 30 years. 1 or 2 years of non-activity but having learned is not going to make a difference to your life. Young professionals need to keep that in mind. As I said, not investing capital is also an important skill set. So for all of those young professionals who did not do a transaction, they should have been able to articulate that the reason why we did not do the deals were A, B, C, and we learned a lot in doing that. But somewhere in those days, some of the professionals did not understand that. And therefore, obviously, when you have a churn in your team, when you go back to your investors, one of the questions that the investors ask you, how stable is your team? They actually ask you, what is the turnover of the staff in your team? And if they see a high turnover of the staff, they get worried about giving you new money. So managing your own team's expectation, managing attrition of staff, managing to stay out of market because you have certain convictions, these were learnings during those turbulent times. Bull market, everybody is very happy, everybody is doing stuff well. But it's the difficult time that teaches you a lot of lessons. And that's what happened after the IL&FS financial crisis. COVID is another period that I would like to talk about. In the COVID period, when nobody was sitting at home, everybody was sitting at home, we had a very large amount of dry powder in our special sit credit fund. That's not here, but we'll talk about that. In the special sit credit fund, we had raised about $1.6 billion against what we thought was the non-performing loan opportunity that's going to come about in the country. But COVID happened, and that itself became a special situation. During that COVID period, when none of the global investors were willing to invest in India because they were reading horror headlines in the Wall Street Journal and The Economist. Nobody who is a representative of a global firm sitting in India would have had the guts to put up an investment committee proposal which will go to some bunch of people sitting in London and New York and who would be able to see the reality of what's going on in India and approve that investment. We were sitting here, feet on the ground, our investment committee and my colleagues, we understood what was going on. In that COVID period of 20 months, out of $1 billion fund, we invested $780 million. And today, 2.5 years later, that fund is comfortably generating a 22% return. On the back of that, we've been able to raise the next fund, which is $1.6 billion. And today morning you saw one of the other investments that we did in a diagnostics company. So important thing that I want to communicate here is that think for yourself, think about the reality that you are facing and have the conviction to act upon it or not act upon it as the case may be. You may go wrong on some occasions. We have been wrong on some occasions. It's not that we have got everything right. I can tell you today that 20% of the capital that we invested in this fund, it's now nearly 14 years, I still have one of those investments which we have not been able to exit. And it is a lesson in terms of what you should not have done. So it's important to, ingratiate those lessons, not repeat those same mistakes. You should, of course, have the luxury to make new mistakes, but try and avoid that as much as possible. But 3 things I would want to summarize by saying, have the patience, have the convictions, and learn to stay out of market where you don't have the conviction that the market is at the right valuation. And finally, of course, insofar as investors are concerned, many of the investors who actually gave us money at this time, this particular fund, by the way, did not perform well. That was a fund that has generated 2.5% return. That's the only fund that has generated 2.5% return. All other funds have returned 19% return. But that 2.5% return compared to all other peers who were real estate funds at that time, most of them had actually lost capital. We were the only ones who had actually returned capital, and investors have told us that that's been a big differentiator, and part of the reason why we got money from investors thereafter was because of that. So investors understand that. They are mature investors. The Indian market obviously is currently undergoing a change, and we'll talk about that further as we go ahead.
Excellent. Thank you so much for those insights. And I think that one slide, it's so informative because that's the whole journey that you had right from when you started. And, and thanks for sharing some of the mistakes as well. But we'll delve a little deeper into that. But before we go there, I think one of the other things that distinguish you from most players on the street is you have funds across the alternate conundrum, right? The whole asset class within alternates, and you have a whole spread there. But most other domestic houses, most of them are specializing in either, let's say, private credit or real estate or special opportunities, etc. Just for us to understand, what's the advantage of having, within the alternate space, a lot of asset classes, a lot of funds, versus someone who's specialized into any one of those areas, let's say real estate?
No, I don't think there is any advantage or disadvantage. I think both models work. You could be a specialist private equity fund manager, or you could be a specialist real estate fund manager. When we started the business in 2005, 2006, honestly, that was what we are today was not in the horizon or in the vision at that time. We said, I remember when the first fund was $100 million. Yeah. And I used to tell my team that, look, if we are able to grow the AUM in the next 3 or 4 years to $1 billion, I'll be a very happy man. And so I think the team was sort of enchanted with this $1 billion number, and we were sort of working towards that, multiple funds and so on and so forth. But once you got to the $1 billion, then you got to have another target, right? And we started thinking about maybe $3 billion. But somewhere at that cusp era, one also realized that the market was changing, opportunities in India were changing, and we started looking at what are the business models of some of the big guys who are doing this in the rest of the world. So, and therefore, when you look at the bigger players, global players, whether you look at Blackstone, KKR, Carlyle, all these big names, Brookfield, they have all of these verticals. They have a buyout vertical, they have real estate vertical, infrastructure vertical, credit vertical. And we thought, why can't we create an institution like that for India? We've had the experience of being a partner with Goldman, and I was privileged to be part of the joint venture with Goldman, and I learned a lot of things from them. And we felt that aspirationally, if we can build a firm like any of these global firms which are multi-asset class, we should give it a shot. And that's what triggered it off. And in any case, my first love was capital markets because I was part of the investment banking business. So transitioning to do other stuff which is non-real estate was easy for us. But I must give credit to the team members. So each of these verticals in Kotak is run by a CEO who is fully empowered. My role is provide direction. Obviously, I'm the face of the firm, so go raise money along with the specific CEOs and building the team. But the key is the rest of the team and the alignment of the team with the goals of the firm. One of the things that we do as a firm is that, in all of these alternative assets, as all of you know, the fund manager, management firm takes a carried interest, which is a share of profit. In our firm, right from 2005, 2006, we've had a policy that 50% of the carried interest goes to the team. So it's like a partnership between brand Kotak and the people who are actually running the business.
Right.
And that makes a big difference in terms of being able to retain people.
Yeah.
And I insist that the CEOs of each of those verticals, whether it is private equity, private credit, real estate, must invest their personal capital in the same funds. If you don't do that, you're not going to be doing your own job with the same level of diligence that you would do with your money versus other people's money.
Always the case. Completely agree with that. So you have to be invested along with everybody else.
Absolutely.
Yeah. And that's why it's a LPGP, a partnership kind of structure. One last question from me, and then then we'll start addressing these. I think this is great to see your journey right from the early 2000s till now and how it's panned out. And there are so many lessons that you shared with us. But as we all keep saying that investing is a business where you're looking into the rearview mirror, but you're really driving ahead. So at this point in time, where we are and where India is and where your funds are, etc., what are those few things that you want to share with us, which are going to determine the next 5-10 years worth of returns for people here who are working in different asset classes and all of that? And also a few words of caution that at this point in time, wherever the markets are in your view, we should all be taking into consideration.
I think first thing that we need to understand is while we learn lessons from what happened in the rest of the world, we have to temper it to the realities of how businesses will evolve in India. And it is not necessary that we follow the same path that other markets have followed. There are macro indicators which are similar. For example, in the US, when the institutional investors started putting money in alternative assets, it was during the Reagan era when he really opened it up for the pension funds and others, and the 401k money coming into the alternative assets. That inflection point has not yet happened in India. The reason being that if you look at your own long-term savings that all of us have, the largest proportion of our long-term savings in India are sitting in gold, illiquid. Second is real estate, illiquid. And financial savings is sitting with Life Insurance Corporation of India, Employees Provident Fund Organizations, and National Pension Fund. All the three today combined regulatorily are permitted to invest in alternative assets. That combined number is approximately 6 lakh crores, what they are eligible to invest as per present regulations. Against that number, what they have actually committed is 15,000 crores. So 6 lakh crores was so the institutional capital that we already have in the country has not yet moved into the alternative assets. And that's the first thing you need to understand. So there will be an inflection point that will come when a lot of the institutional capital will move into alternative assets. That's the first point. I think the second factor in that is that, and it's all in all likelihood, since you asked where I would take a bet on that if I were to do that, I would probably take a bet on long-term income producing assets. Why? Because all of these are long-term liability products that an insurance company produces, pension fund produces, and others. Yeah. Our policy makers and our regulators do not do enough justice to you and I as taxpayers and savers. Simple math on this is, if you look at what the country needs with regard to investment in infrastructure, today the government of India takes your taxes, builds the roads. Once the roads are already built, the tolling is happening. You, me, my children will pay the toll for the next 15 years. They will gift wrap it and give it to Canada Pension Plan, CDPQ, Brookfield. Is that we should be owning those assets. We, when we retire, should get the income out of the assets which are long-term annuity assets. And that best way to do that is through our own pension funds, our own insurance companies, our own provident funds who are not doing it today. But my bet is that People realize that. It will change. So I would really load up on long-term annuity assets in the current market because there will be a tsunami of capital that will come into this. I've also heard another leader in the private credit industry, the CEO of Apollo. He used a very interesting term. He called it the silver tsunami. The silver tsunami is the aging of the population in the developed world. All of those guys who have got retirement money and they're living much longer. And they need their money to earn long-term annuity income. And those annuity income could be anywhere in the world, including in India.
Yeah.
So a combination of the domestic silver tsunami and long-term assets and international money would chase long-term income-producing assets. So I'm very bullish on that particular space. It could be anything. It could be road. It could be solar platforms. It could be office assets. It could be retail malls. I'm very bullish on that over the next 5 to 10 years' time. You need obviously to pick the right ones, but very much from a trend line point of view. I think the second, I would say that if we have to realize our dreams as a nation, we leapfrogged in the telecom sector from fixed line directly to mobile. And we think that we will leapfrog in the artificial intelligence era, for which the kind of infrastructure that you require in data centers is going to be very, very significant. We believe that will most likely happen. And if that happens, that's going to be the next big area that you have to look out for. And anything that feeds into the development of these is likely to be a beneficiary from a investment and return point of view. And the last is, while a lot of people talk about climate change and renewable energy, the amount of money that's going to be built going into renewable energy, whether the energy company make money or not, I don't know. But a lot of people who are going to feed into that energy company, setting up those platforms, will do extremely well in the coming future, 5, 7 years' time. So thematically, these are the 3 or 4 themes that we are very, very bullish on.
And you have funds that are targeting these spaces?
Yes.
Or you have plans to raise money in those areas?
Bit of both.
Oh, great, great. So we know where we want to focus on, right? For the young guys, folks, even if we've made no investment over the last 2 years and you want a job, right? Yeah, this is an interesting one from Miss or Mr. Anonymous. It says, given the nature of private markets, what points in particular should be looked at while evaluating a private market investment manager, especially in India?
First of all, as I mentioned, alignment of interest. I do know that in the domestic market, a lot of new private market funds are coming up.
Yeah.
And it's important to see whether they are putting their own money along with your money. Whether you're a distributor, whether you are an investor, that's the first thing that I would ask. I think the second I would look for is any related party transactions and conflict of interest. So it's very important. For example, I can tell you in credit funds, and credit funds which are run by firms which also have a credit business. Like for example, Kotak Bank has a credit business. We also have an NBFC business, and I also run a credit fund, right? It's very easy to camouflage a transaction where your own syndication arm is charging a fee to the issuer, maybe 1.5%, and the fund is investing and providing money at 13.5%. If the fund and the fund manager is actually able to originate and generate the transaction, that 1.5% fee that is booked by your own left arm could actually be part of the return for the investors. It doesn't mean that that situation is never going to happen, but you need to watch for what is the level of related party transaction disclosure that the fund and the fund manager is going to make to you. You then form a judgment. For example, in our funds that we manage, we actually have it as part of the contract with our investors that any related, and these are large funds, $500 million, any related party transaction which is greater than $200,000, we have to report that annually to our investors. Now, I do know that in the domestic funds and domestic fund documents that I've seen, these kind of practices are not there. And there are a whole bunch of other, I would say hygiene factors which one has to really look forward to, because this is not an asset gathering game. You have to look at this business as a game where the investor and the manager are both going to make money because the investment is going to do well. And that alignment of interest is very important.
Very interesting, and something for new managers, especially in the Indian context. You mentioned endowments and foundations in the US. who are very open to or wanting to back independent managers, saying, if you're working for a brand like Kotak or Templeton, then why are you doing that still, right? That kind of. So in the Indian context, and we have a lot of budding managers here who are, either evaluating or have started that journey, what would be the advice of where they should be going to raise this capital?
I think in the current environment, right now, global investors have their own preoccupation with regard to allocating capital to India. I would say if you are starting to raise money today, don't go global right now. There is enough money in the domestic market. Go to the domestic market to raise money. Global fundraising market right now is very, very challenging, whether it is credit or for equity. In credit, global investors are getting extremely attractive terms and returns in US market and dollar denominated returns. So your focus should be, if you're starting out now, to raise money from the domestic market. Domestic market, unfortunately, is driven by being a distributor-driven market. Yeah. Whatever you pay, the highest to the distributor gets you the money. And that is an unfortunate truth of the domestic market. And I do hope that many of you who may be practitioners and who may be either a distributor or working for a distributor, please ensure that the selection of the fund that you decide to market to your customers is based on the performance and the alignment of interests rather than the commissions that you as a distributor earn. Because as the great Amitabh Bachchan said, "Sare murgi ek hi din khaoge, ya ande aaj hi chahiye ki baad mein bhi chahiye."
Great. There's a question from Namit Arora about real estate private equity. He says real estate PE is a particularly difficult asset class in India, as we all know. Please share some key learnings from it over the past couple of decades.
I think, first of all, it's a very cyclical industry, so you got to get your cycle study right. And it is a tough industry because you are dealing with counterparties who are not necessarily the most professional counterparties. Yeah. If you leave out most real estate funds, by the way, if you're not doing equity investments and if you're doing credit investments, are likely to be dealing with developers who are not the top 10 or top 15, because those guys will never borrow money from you at high interest rates. So you are going to be dealing with counterparties where compliance, professionalism, etc. will be somewhat lacking. So you got to have those systems and processes to put things in check. I think the second thing is that many people come into real estate thinking that it's a very, very high return business. The truth is, it is not. And this perception that it is a high return business is built on the myth that everybody in your cocktail circuit, after 2 whiskeys will be telling you, my grandfather bought this piece of land for 1 crore rupees, it is now worth 30 crore rupees. So it's a fantastic investment, but just do the math on the IRR on that and you will come to single digit IRRs on that. Residential real estate, for example, however hard you calculated, residential real estate in the last 25 years have not given you a return, long-term return of greater than 14%. The only reason it works and people are happy about is because you are able to, as individuals, get leverage to buy residential real estate. You don't get leverage to buy stocks that easily. Yeah. So on a levered return basis, it makes sense, but it can go the other way as well in India. So I would say that, it's real estate investing is a business for bigger boys, bigger checks. If you are writing smaller checks, then you're competing with private financiers. Yeah. And that is a difficult market to operate in.
One more question around real estate, since we're talking about that. Varun Jain asked this question. Which city do you think has real estate which is sanely priced? Where is Kotak Realty Fund investing more these days? And your views on the Mumbai real estate? Where's Varun? Yes.
Look.
You don't beat around the bush, right?
Whether it is sanely priced or insanely priced depends upon your purchasing power. But I would say that, I don't think the markets are overheated. NCR market, for example, is a completely different ballgame. You cannot understand that market. It doesn't work on rationality. And within NCR market, Gurgaon is totally different from Noida. So rationality doesn't work. All your stuff that you learn in your books, I will do data analytics, I will do demand supply analytics, none of that works in that market. It's a market operating at a different planet. There are many other drivers of those markets compared to some of the other markets that we talk about. Fundamental difference, the reason why it operates that way is that unlike in Mumbai, for example, if you make your down payment, you're supposed to register the property. So stamp duty is paid after you pay the initial down payment. In NCR market, there is no stamp duty that is paid. So it is like a perchi trading that is going on. And that is the reason why that market sort of rotates assets very fast. And the day they bring in that regulation, there was some talk of bringing that regulation, and there are a whole bunch of guys who are up in arms, and guys who do election funding are up in arms against it. Anyhow, so that's a very different market. Chennai market is still a reasonably priced market, I would say. Bangalore is also not runaway yet. Mumbai, certain micro markets are possibly overheated, particularly the luxury segment is overheated. But otherwise, I don't see overpricing in the current market. Where we do see underpricing right now is actually in the office market. There isn't going to be enough supply at office against the demand that's coming up in cities like Mumbai and Delhi and Bangalore.
Yeah, agree, yeah, absolutely. Good, now you know where money is going, huh? So again, in the Indian context, what's your view on buyouts versus minority growth PE? Has it changed over the last 20 years?
Look, I think it's a mixed view, I would say. From our own firm's perspective, we believe that controlled buyout is the way to go forward. Is there no room for minority PE? I think there is certainly room for minority PE, but you've got to be very, very careful because the exit mechanisms, if you have not negotiated it well, and if you have not made the bet on the right promoter or shareholders, can be challenging. We've gone through both exercises. We used to do minority equity earlier. We've abandoned that. I mean, we did that fund now about 6 years ago. We don't do minority equity fund anymore. So we chose to do two things on the private equity space. One is that we are pivoting towards buyout funds because we think that we now have the size and heft to do that. And the second is that if you look at the rest of the market, we felt that we need to pick a spot which makes sense for us and also makes sense for how we can make a difference to the country. And there were two choices in front of us, which is early stage venture capital kind of strategies. One was artificial intelligence and technology. The other was healthcare. We chose to do healthcare, where we will willy-nilly be doing venture early stage investing. And those obviously would be minority, but we believe that being a large institution, we will be able to sort of manage that. In any case, venture investing is more about the bet on the founder and the founder actually getting it right rather than us doing a lot of heavy lifting.
Yeah. So interesting. There's a question by Saili on this aspect that you mentioned about VC investing. Do you think that the current IPO frenzy will continue to deliver value to VC exits, or will the trend decline over years?
Look, IPO market has always been cyclical, and we are probably at the latter half of the cyclicality of the market. So as the secondary market starts tapering off because of earnings growth for the current year is not likely to be what the market expects, and the market is currently overvalued relative to the earnings growth that corporate India is expected to deliver. So it's quite possible that the IPO market will see some kind of a tepid growth in the coming financial year. Having said that, for quality companies, IPO markets will always be open. So barring any black swan event, if you got a good quality company, you will get exits in the IPO market in India. You may debate whether you'll get a fancy valuation or not, but you'll get reasonable valuations in the IPO market. Domestic liquidity will continue to support the IPO market.
Excellent. I'm mindful of the time, but we still have our last 5 minutes. So here's one question from Mansi. It's a little micro now. With SEBI's introduction of SIFs, specialized investment funds, aiming to bridge the gap between mutual funds and PMS services, portfolio management, how do you foresee this new asset class influencing private market investments in India?
I think if you look at the Indian market, you have category 1, category 2, category 3 funds. India is the only market which makes the differentiation. It is it is unfortunately a legacy of our taxation regulation that we have these. The most impacted party on this new asset class is going to be the category 3 funds which are investing in the public markets.
Yeah.
My sense is that if the new asset class takes off, unless you are running a very esoteric strategy in category 3 funds, most other category 3 funds will die. Investors will go into the new asset class.
Well, interesting times ahead for that. This is an interesting one from Saurabh. How do you identify and interpret key indicators or signals to gain insights on the timing of cycles? And I think this is more to add in light of these cycles that you mentioned, and there were times when you just sat out of the market, there were times when you exited everything, all of that. So what are those parameters, and how do you identify those?
I think, first of all, I would say it's a combination of 2 or 3 things. One is you keep in your radar always what is the big macro pictures that's going on. And many of the macro indicators give you leading indicators of where the economy and the market is headed. For example, in the NBFC case, for example, we were trying to do deals in the market, and we found that a lot of other NBFCs were willing to do the same deals. In a deal, if we were offering, let's say, 150 crores, an NBFC would come and offer 200 crores or 220 crores. And we were scratching our heads to say, how can this actually be justified? And you will see those kind of situations. Irrationality can easily show up if you are operating in the market. And the day you feel that you are being completely outpriced and that you've been sort of, you have your conviction whether either you should change course or you should stay your course and stay out of the market. I think our experience has been that whenever we see something which looks like too good to be true, we stay out of the market. In each of those cases, NBFC, for example, we just found that every Tom, Dick and Harry was setting up NBFCs, and they all wanted to do real estate funding. And most real estate developers would come to us, they will negotiate a term with us, and then 3 weeks later you find that some other NBFC has given them money at a much lower rate. Yeah. So mispricing of credit risk is a leading indicator of things likely to go wrong. And at the cost of sounding prophetic, I can say that there are too many private credit funds which are opening up right now.
Yes.
And by December this year, you will see mispricing of credit.
All right, like you said, prophetic words. So, ladies and gentlemen, as promised, you heard from one of the most experienced voices on the street in terms of alternate assets. Thank you so much, Srini, for sparing your time and your thoughts. Big round of applause to you.
Thanks a lot, Srini sir and Rajesh.
Thank you.
I would like to invite Jenna. Please, if you could come on stage and give them.